How's it going, everybody? Welcome back to your favorite Satoshi Club, and in today's video I'm going to discuss the fall of FTX and all of these other platforms and how it was not actually decentralized finance or the decentralized world that failed us, but it was the centralized one. What are the key issues of a centralized financial system? That is what we're going to discuss in today's video, and if you enjoy it, as always, check out the Satoshi socials down below so you can stay up to date with all of the news coming out in the crypto world and be the first to know everything. So without further ado, let's just get straight into it. FTX showed the problems of centralized finance and provided the need for decentralized finance. And this guy, Sam Bankman-Fried or Freed, his crypto trading empire came very, tumbling down. He went from a net worth of around $20 billion to around $100,000 in his bank account. At least that's what he's saying. Now, does he actually have money in shell accounts all around the world? Nobody knows, and he probably does if he's in any way, shape, or form smart, which he probably should have been if he was doing what he was doing so far. But that's not our concern right now. Our concern is how FTX, caused a little insight into the entire regulative and the entire world, finding out that CeFi is actually more dangerous than DeFi. And how do we learn this? Well, we had lessons along the way. We have Celsius, we have BlockFi, we have Voyager, we have FTX. Celsius website is off. They're bankrupt. Voyager updates, bankrupt. BlockFi, November 28th, bankrupt. FTX exchange, BlockFi was actually very recent, and FTX just sends you to the help center, but even if you do anything, you're not going to get helped, because it is a centralized exchange, and centralized exchanges tend to disregard the consumer completely in times of crisis, which was actually proven back in the day in 2008 when the economic collapse happened during the housing market. So what happened with the big banks that went bankrupt? Well, some of them took the fall, but some of the other big banks just got bailed out by the government. But what happened with the normal average Joe, with the average person? Well, the consumers, or the bottom 90%, took the toll of the entire financial crisis, and it was a very difficult year, very difficult few years, very difficult next 5-6 years of growth. But finally we are in some better times, but it's kind of getting worse right now as well. But that's besides the point. So we have seen this before, where centralized institutions collateralized, under collateralized, and took risks with user funds, and were hence insolvent when they were supposed to be solvent. They were illiquid when they were supposed to be liquid, and they managed to cause this bank run, because when you hear that one bank doesn't have money to pay your friend out, you're going to go to your bank and everyone's going to be there already waiting in line, and the bank can only pay out the first amount of people that come through, because the bank's policy is that if you have 1,000 people waiting in line at the bank, it's not hey, we have this much in assets, we're gonna split $1,000 for each person and that's what we're gonna give them. No, first come, first serve. If the first guy comes to the bank and wants his $3 million, the bank's going to have to give him his $3 million. And at some point, if the bank is insolvent, they're not going to have that money and they are not going to be able to pay him, which is absolute catastrophe. And that is what happened in 2008 to the Lehman Brothers and a few other banks. But that is what also happened to FTX. And FTX actually caused somewhat of a bank run to a lot of these other institutions right now, these centralized exchanges out there, where prices just kept dipping, investors taking out funds and all of this stuff, and it is completely normal. People are scared for their funds because they're using centralized exchanges. Now, something that was actually here to solve this is, well, whoop-de-doo, Satoshi Nakamoto inventing Bitcoin back in 2008. And Bitcoin aims to solve all of these problems by creating a decentralized network that this would not be able to happen on. And even though these large institutions spent years on privatizing gains from taking risks that led to this enormous collapse, and once this collapse actually came, they forced the public to bear their losses thanks to the influence on politicians with discretionary decision-making power. Still, Satoshi came in there and changed the locus of decision-making from politicians to an automated code base, giving the regular or average Joe the option to permissionlessly participate in the blockchain, where rules are public, apply to everyone, and execute completely automatically, so you can always get your money back, right? If you're using a centralized exchange, you're probably not going to get your money back once they bankrupt. But as you can see, despite all of these sell-offs happening, Uniswap, Balancer, Curve, and other decentralized exchanges and DeFi platforms have been functioning completely smoothly, where you may be bearing the loss in price, the fall or rise in price, but you're never going to lose access to your funds, which is a key thing in the crypto world right now. Now, this collapse of FTX and Alameda Research has triggered a run on the banks across crypto markets as well, which is normal, but some of them must be insolvent, and this will, cause a lot of other players to go down, such as, what happened to BlockFi. They were over leveraged with FTX as well, and they just got destroyed, right? But it's just important to know that centralized exchanges are not as perfect as it sounds. And as you can see, there is a pattern, all of these. So what do we have here? We have Celsius, BlockFi, Voyager, FTX. They're all centralized exchanges. And that's the pattern that we can see happening right here with all of these crashes and everything that is going on. Now, a large number of venture capital firms and Web3 companies said that a significant portion of their assets under management or treasuries were lost to centralized exchanges. So there is a pattern forming, and the best way, for me and you to react to that is keep minimal funds on centralized exchanges only for immediate trading, and everything else just keep it on a ledger. Okay, keep it on a ledger. Don't do anything with the money. It's a lot smarter to keep it on a ledger. It's a lot safer to keep it on a ledger, and I fully recommend you do that. Now, furthermore, decentralization is the answer to all of these problems. Why? Well, DeFi platforms are actually designed to preserve the benefits introduced by Bitcoin and magnified by Ethereum. It's completely permissionless, it's completely transparent, censorship resistant, and self-sovereign with the custody of assets, where basically decentralization would have stopped all these problems. But the problem was that FTX, for example, was completely centralized, right? And they spent their final weeks spending lavishly to court regulators and using all of these depositors' funds, and SBF, or Sam Bankman-Fried, even had the audacity to say that DeFi needed consumer protections, while, as has become abundantly clear, he was playing fast and loose with user funds. What an idiot, this guy, right? And let's, move on. Centralized platforms see DeFi as a competitor, right? Countries see DeFi as a competitor, but DeFi is not failing us. It hasn't failed us quite yet. It is there. It is automatic. It is it's gonna be there until at some point, which I hope doesn't happen, is gonna get regulated, and then they're gonna ban it or something. But I don't think they can ban full decentralization, because you would need to ban the electricity supply to the entire world if you wanted to ban a whole blockchain such as Bitcoin is, for example. But just to summarize this whole situation, this is a very nice sentence that I've seen right here, so I'm just going to read it straight out for you. Regulation that doesn't overprotect incumbents or harm actually decentralized projects could be a boon for the industry, offering the clarity institutional investors waiting on the sidelines need to start deploying capital. It could clear out space of many of its scams by making it riskier to perpetrate them. So this basically means that regulation that is not overly protecting, all of these CXs, and it's not overly harming decentralized projects, could be very, very good, because a lot of these institutional investors would see it as a bullish signal and they would start investing. And also it would clear out the space of any other scams, right? So if there's a silver lining for this whole FTX fiasco, it is that layer 1 blockchains that deprioritize decentralization as a design goal have been the hardest hit, and all of those blockchains that are still focused on decentralization are staying alive, and that's pretty much it for today's video. So the FTX collapse was a failure of CeFi, not DeFi, and we're all up about decentralization up here in the Satoshi Club. So if you enjoyed the video, drop a like, subscribe to the channel, comment down below with your favorite thoughts and opinions, and lastly, I'm not a financial advisor, and you should do your own due diligence before investing into anything in the blockchain, crypto, or NFT world. And with that being said, I really hope you guys enjoyed it, and I'll see you all in the next video.